It's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub, joins us. She believes the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she helps us define the marketing words long, short, and grain position accounting. Elaine, let's start with defining grain position accounting.
Well, when you're talking about keeping a track of how much grain you have on your position, which is how an elevator would do it, you're talking about looking at each time frame and deciding whether you are long or short in that time frame. Do you own grain in that time frame, or do you need to source more grain in that time frame? So the way that an elevator would look at it, for instance, they might be long grain now in their inventory. They might be holding a lot of grain from the past harvest, but they may have obligations through March, April, May, farther out time frames that they are short and that they have already sold grain there, but they're going to need to buy in grain to cover that short position. So that's an example of how, grain accounting is different for each time frame.
And then when you look at not just the time frames, but the position itself, can you define a long position and then a short position?
Yeah, and this is an easier topic, I think, for people in the grain markets to understand than investors that may not be coming into this from the grain market. Farmers are used to selling grain before they have it. You know that you can go out to the elevator right now and sell your 2013 production a year out already, and it makes sense because you know you're going to have that. But for stock traders, let's say, or investors who just aren't used to selling grain, to say that you are short a commodity doesn't really make a lot of sense to them, that they can go out and sell something that they don't presently own. But the way that the commodity markets work is that you don't have to buy something up front. You're just making basically an educated guess on whether the price is going to go up or down. And if you believe that the price is going to go down, you can sell high now and buy low later.
And in that case, you would take a short position.
That's right. That's called a short position if you have sold a commodity or sold an asset with the intention of buying it for a lower price later.
And you actually don't have to have the grain at all.
Yeah, not at all. When you're talking about selling grain or selling grain in a position, you do have the intention of eventually owning grain that you will use to cover that short position. But if you're investing, you can just sell a futures contract right now with the intention of just buying it back at a lower price later.
Yeah, and the important part is that you need to buy it back, because if you don't, eventually you will have to deliver grain and you will have to source some grain someplace.
Yes, exactly. One way or another, you will have to cover your short position, yes.
And then a long position is the other side, which means you would buy a future on the idea that it might be going higher and you could sell it later and make money on it.
Correct, and that's easy to understand when to an investor who may be used to buying stocks, for instance. If you buy some Johnson & Johnson stock, you are now long Johnson & Johnson stock. And with commodities, it's the exact same terminology. You're just long whatever you're buying. And that, again, is easy to understand in the cash grain markets. You own some grain, so you are long grain, and as long as you remain long grain, your investment position is that you are hoping to sell it at a higher price later.
Are farmers eternally long the market?
They are. For as long as they intend to continue farming, the very definition of being a farmer is you must farm something. You must produce some grain. So as long as you intend to be a farmer, that you will be producing grain in 2013, 2014, 2015. So if you were going to write your cash grain position for all those years, you would be long in October, November, the harvest time frame of all of those years. You know that you will own physical grain at that time frame for all of these years of your life.
And end users are like ADM or Tyson Chicken or other places that might be using grains and oilseeds would be eternally short the marketplace?
Exactly, because they know for all of the years of their life that they will be using this grain, they're going to need to be using that grain every month. So a Tyson chicken producing outfit might have a grain position that is short a certain number of bushels every month that they know they will have to buy in to feed their chickens.
And the middle person, the elevator, can they do both?
They can do both. They can choose, if they have a bullish or bearish opinion for any time frame, to be long or short in that time frame. The exception comes in for co-ops that are owned by farmers and therefore have some sort of they're basically obligated to take the grain from their farmers, and that's what they are being employed to do, or that's what they're in existence to do. And when they're obligated to take in harvest grain, for instance, then they can't really choose to be short at harvest when their farmer owners are telling them to buy grain.
Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub. She joins us here on the Closing Market Report to define marketing words. I'm University of Illinois Extension's Todd Gleason.